Hi, Uncle Fu. Hello, hello.
Hey, Angafu. First one in.
Yes.
All right. Now, if all of you are joining us over here right now, just leave a note in the comments, drop a note, say hi so we know you're with us. All right. Hi, Josephine. Thanks for turning up on every live session that we have done so far. Hi, Jim. Aha, the Facebook user strikes back. Once again, if you are joining us live for the first time in our public Facebook group, can you click on the StreamYard link? Okay, so we would be able to see who's dropping a note to us on the back end based on the streaming software that Jeremy and myself is on. Okay, because if you don't click on the link, this is how we see you. Okay, and obviously we don't enjoy seeing a Facebook user. We rather know, we rather know who you are, so we will address you more personally over here. Okay, now, so please, once again, if you're joining us for the first time, click on the streamyard.com/Facebook link, if I'm not wrong, and then click on the Facebook button after that, and we would see you right after that.
So, Terence, how's the week of trading for you?
Not too bad. Difficult week, but not too bad over here. You just need to look out for the right opportunities on the stocks that you're comfortable with. And, I actually do see a couple here and there.
That's great. Myself, I also look at some tricks. Yeah. So
I think one of the main thing though is to be wary of the market risk because it is obviously still very evident. So I would address it a little bit in my usual section as part of this series over here. Okay, all right now. So more or less, we've got some of you joining in here together with us. Thank you very much. We'll, of course, aim to start the sessions on time as much as possible. So I think let's get into the habit of doing that, Jeremy.
All right, let's start then, Terence. Terence, on to you for the market outlook.
Great. All right. Thank you very much. Now, before I do that, those of you who are already joining us in the session, if you could, share out the videos that we are broadcasting right now, it would help us a lot. Today we'll be finalizing on the part two. All right, part two of the Momo stock that Jeremy has touched on. And then we'll also have a little bit more time for questions today. Okay, so I think that's good as well. We have more time for questions. And then also, I'll be doing a little bit of market briefing, okay, on trading for the following week. So just to provide you a little bit of the market sentiments, so you know how you want to go about planning your trade in the coming week ahead. And yes, so do help us click on the share buttons over here and also let your friends know that we now have a public Facebook group. So, get them to join the group so they can, benefit from the discussions and the articles that we're going to start to put up. All right, there are going to be more and more that's going to be put up over there. So it's going to be a valuable resource center. Now, all right, so let me get started. Okay, so thank you for taking time to still join us because I know that I did say we won't be able to do this because Jeremy, it's tied down this weekend, right? But he's freed up his appointment, so we are announcing it and we are still going ahead with the scheduled sessions on the weekends, right? So let me get to my part. Okay, now, so getting a little bit to my part over here, what we'll do as usual is we'll look at the index first, okay? And the thing right now is this. When you look at a chart, so for example, if you look at the chart that I have on my screen right now, okay, there is what we call very little. There's very little that you can see or tell from the chart. That means, Jeremy, if you look at the chart on my screen right now, would you say it's up, or would you say it's down? Would you say it's bearish, or would you say it's bullish?
I can't really say for sure if you really ask me.
So that is the problem. That is the problem. So a lot of the more, how do we say this, less experienced or the newer participants in the market, right? When they look at the market right now, they are really a little bit uncertain. That means they don't really know. They can't really tell if the market has turned bearish, or the market is bearish right now, or how much further could it potentially go down by, based on what it has already done. Yeah. Okay. Now, so the thing now is this. I'm just going to change it up a little bit. I'm going to put the SPX instead. Oh man. Yeah. Okay. Now, give me a minute. Let me redraw all my drawings. Okay. Now, so the same thing happens. You just can't make out anything, right, Jeremy? Now, so when you look at this and you can't make out exactly what direction and where the risk is, right? What you should do always is this. You should lengthen the periods that you're looking at the chart, right? That means instead of looking at it day by day, right, you should start to look at it longer term, right? So that you kind of have a feel of, in the longer term perspective, right? What is the market trying to do, right? And now when you look at the charts that I'm putting up, I've just changed it from a daily to a weekly chart. And, you can start to see that, market was pounding up higher almost every week since the COVID market correction. Okay, so that was a very clear, bullish kind of, let me change it up. Okay, that was a very clear bullish kind of sign that we have over here. Oh man, draw it. It's not gonna draw. I have no luck with these drawing tools. There we go. Okay, now, so it's been a very clear kind of like a bullish up move over here that we have. Now, and then we had this one severe week over here where the market turned, right? And actually 2 weeks ago, when it kind of followed up in terms of a weakness, right? Or there's no rebound back up, right? Okay, that actually, kind of changed the long-term outlook a little bit. Okay, this is going to sound very, very funny because what I was about to say is it's changed the long-term outlook in the short term by a little bit. All right, now that means we are looking at a long-term chart, but in the near term, that means maybe in the next 1 month or 2 months, right? It doesn't look like the strength in the market is still there. That's what I'm trying to say. Now, because if you look at this, right, we are nowhere near the middle line of the Bollinger Band. Okay, now, so as you see over here, right, what you have is the prices going from the bottom of the band all the way to the top of the band, correct? But once it hits the top of the band, then what you do is you will start to see that, right, it will start to come back to this middle line, right, which is actually the moving average line in the Bollinger Band, right? And then after that, you may decide to continue going higher. We don't know.
Terence, you want to try zooming into that so that the participants can see a little bit clearer to that?
Okay, I hope this helps. Okay, now, so when it goes to the bottom of the band, after it is done, all right, what you'll do is you'll cycle back up to the top of the band, all right, and usually when it hits the top of the band, right, it will start to come back to this middle line. So what happens is, the middle line is kind of like the fighting point. If the uptrend is intact, right, that means when it hits the middle line, you'll get some support, and then it will resume and go back up to the top line again. Okay, now, so the issue is this. We had this, full cycle where it went from the bottom to the top. Okay, and we have not had the retracement back to the middle line yet. Okay, and we may actually just be seeing the start of it now. Okay, and we do see the start of it now, right? Now, the problem is this. The problem is, as of now, the Bollinger Band is at 3,200. Okay, it's at 3,200, and we are only at 3,300. Now, that means, all right, we could still see another at least 100-point sell-off, 100-point sell-off in the S&P 500 index. Okay, now, so that's one concerning point I have. Right now, of course, the other concerning point that I have is the RSI has already started to come back lower, right? And then we had a clear crossover in the stochastics, which is, of course, we can't use the word bearish, but more on the downside in the near term. Okay, but the MACD is not cut yet. Okay, so this is the only thing that keeps the uptrend still intact. Okay, but the momentum has weakened. That means you see the severity of the bars, right, is getting thinner and thinner. Yeah. Okay. Now, so that's just the outlook. But combining some pictures together, right? Combining some pictures together, it tells me that I should be a little bit more careful with the market. Okay. And what do I mean when I say this? What would you say would have been that one stock? That means if you have to label the one stock, okay, in the S&P 500 this year, okay, that would be your top performer. Okay, your top performing stock. Now, Jeremy, which stock would you say it is?
Tesla?
No, Tesla is not in S&P 500. Tesla is definitely the top performing stock. It's the top dog, right? Okay, but
Right.
It's not in the S&P 500. So let's consider the S&P 500 companies. Okay, what would you say is the top dog?
I don't really.
Which one stock right now can literally move the entire index on its own?
There will be the FANGs then, Amazon, Facebook, and them all.
Not really. It's actually just Apple.
Ah.
It is Apple. Yeah, all right. It's none other than Apple. All right, because Apple is that one, that one of those $1 trillion companies. All right, it's just going crazy. Okay, now because if you look at it, right, Apple went from like the COVID market crash where its new split price would have been like around $58, right, and then it shot to a high of 137. Okay, in just a span of like, how do you say this? In a span of 6 months, half a year. All right, so we could actually say that it almost tripled. Like it went up by 250%, right? Now, and the problem is it is almost $1 trillion stock. That means even in the March sell-off, it was still close to $1 trillion stock, correct, right? Now, in terms of how it influences the entire S&P 500 index, all right, would be very substantial. Okay, now, and the problem now is this. The problem is, if you look at the longer term chart, that means the weekly chart of Apple, right? We are seeing the same thing, right? We are seeing the same thing where, we now start to see that Apple is cycling down, okay? And it may potentially get back to this middle line before, it tests the support, right? And this middle line is actually at like $97 right now, $97. So it could fall by another $10. But then the problem is if this middle line breaks, right, it could cycle all the way back to the bottom of the Bollinger Band. Okay, and if it does that, right, can you see it is actually $66? That means that potentially Apple could fall by another 10%. That means the $10, right? Okay, or right, if things do get worse, right, it could fall by at least another 30-40% before we can say that it's done. Because right now, right, okay, the sell-off is not happening because people are seeing this. Okay, this is one bearish indicator, this two bearish indicator, but this is not. So we would have some people over there, right, who would say, okay, maybe I'm just going to hang on and see what's going to happen. Okay, but something actually changed on Friday, Jeremy. Okay, I'm not sure you're aware of that as well, because now if I change it back from a weekly to a daily, right? Okay, now this is Apple on a daily. Okay, now obviously we have the same sell-off over here. Okay, and from the longer term look, right, you also can't tell much. Agree? Okay, now, but of course you can tell that we have this perhaps this uptrend line over here. All right, somewhat that is loosely, maybe you can say that the stock is on it right now. Okay, but what I'm going to do right now is I'm going to remove my drawing, and I want to show you something. Okay, if you look at the top bar over here, okay, if you look at the top bar over here, can you see that the light blue line, right, actually represents a moving average? It's a bit small, yeah,
yes,
okay, but it actually represents a 50-day moving average. And I'm going to zoom in right now, and I want you to see this. Can you tell me what's happening on the very last day candle of the Apple?
It broke the moving average.
Yes. And moving average is one of the simplest indicators that people have on their charts. And most free charting softwares, right, they already pre-include it in their default settings. Okay, now, and indicators or technicals, right, are kind of like a self-fulfilling prophecy, because the more people look at it, right, the more people will depend on it. So when the more people depend on it, the more people you have reacting on it. Agree, right? Now, so the problem is when most people start to see this happening to Apple, all right, what are they going to start thinking of doing?
Sell?
Yeah, what? the more aggressive cut losses, right? Okay, that means the people who have stronger hearts, right? They will start cutting before things get worse. Agree?
Yep.
Then those are a little bit more wishy-washy, right? Can you imagine if Apple drops by another $10 on Monday opening? What are they gonna do?
Panic sell.
They're gonna panic sell, right? Now, so can you see that Apple is in a very thin line. It's in a very thin line right now. Okay, yes, if the buyers step in, we may have a little bit of a reprieve over here. But if they don't, and Monday happens to be another down day, all right, it's gonna create a sell-off in Apple.
Terence, can I pause you here? Can I
Yes,
pause you
but
there? I don't realize, right, since I think since we know each other in 2016, right, I don't think we actually have a discussion on how the moving average kind of works in a sense,
yes.
like what is the meaning behind that. So I actually did some reading and like for research on my own, like because of like just watching other people's sharing. There's a certain concept of explaining a moving average that I find very useful. I think my participants can actually benefit from this as well. Okay, see, for example, you take yourself out of the stock market context. Let's move the context into a supermarket, a wet market maybe, and you're doing grocery shopping. Say you're going to buy chili padi. Let's say you like chili padi. And the prices for chili padi fluctuates every day because just for certain reasons, this market, the prices of these the vegetables there, they fluctuate very commonly. And you won't be able to really tell whether this chili padi on per day, say, it is cheap or is it expensive without having a relative price to compare it. Because cheap or expensive is something that you need to compare. It is relative. So what you can do is you can introduce a 5-day average, for example, a 5-day average, because there are 5 working days in a week, to compare against the last 1 week, whether the chili padi price now, it is cheaper or expensive. So for example, if let's say the average price in the last 5 days, the moving average price in the last 5 days is say $1, and the chili padi now is at 90 cents, you could say that it is cheaper than the last 5 days. Okay? And similarly, if let's say, for example, the moving average for the last 20 days, it is at say 80 cents, but the chili padi now is at same 90 cents, you could say that the 90 cents chili padi is actually more expensive than the last 20 days, average wise. Now, going in depth more into this psychology, this explanation in English language, what it means is like this. When a stock price cut below the 5-day moving average, let's just disregard whether it's exponential or simple moving average, moves below the 5-day moving average. What this means is the stock prices now is going to move below the cost of entry for the average market participants in the last 5 days. Now, the people who entered at the last 5 days, they bought the stock at those prices, the average prices there. They'll be thinking that, hey, if I'm going to make profit, I need to be selling the stock at above this average price. And if I'm going to avoid any losses, I have to sell it at this average price. So they will be incentivized to actually sell them at this price point, this average price, 5 days worth. So you could count that in a certain sense, because there's 5 days, there will be these 5 days worth of market participants that will be looking to sell their stock, their chili padi, this sense here. Now, if you're going to extend this to 50 days, you'll be looking at 2.5 months worth of trading days, moving average. So what this means now is that for Apple, for the last 2.5 months, people who have been buying Apple shares will be looking to do a stop loss now. So I hope this kind of helps you to kind of rationalize, so what is this moving average line about? Okay, I always been talking about it, cuts below, then something is going to happen, man, when it cuts below. So now you can actually relate to, hey, when it cuts below the moving average, it means that I've triggered the average buying price of most people in the last how many days. So the longer these moving average lines entails, me, say 50 days, 150 days or more, the more the number of participants that this will involve, and the potential, the intensity of this triggering action, be it buy or sell, that will happen. Yeah, Harris?
I want to do something fun. Okay, all right, let's do something fun. Thanks for your analogy over here. But we have quite a bit of you joining us today. Okay, and I'm gonna take I'm going to take a pitch at it too. That means I'm going to explain to all of you from a different manner, from a different product. Okay, and those of you who are joining us, okay, just let us know after that, right? Okay, whether Jeremy's version using the chili padi is easier to grasp or my version is easier to grasp. Okay, right now, because as you were explaining it just now, right, it just led to me to think that this might be easier, but of course, I'm not sure. I may be wrong as well. Okay,
Sure.
now, I do make mistakes as well, of course. Okay, now, so the thing is this: if I had to use it, right, I think it will be more simpler to use the analogy of pump prices. Why? Because for example, chili padi, right? Not everybody goes to the market. Not everybody's going to go and ask for the daily prices. Agree, right?
Yeah.
Now, but when you drive by a petrol station right now, the prices are flashing right outside. You get what I mean? So if you're actually driving, that means every day on the road, when you drive by a certain petrol kiosk, right, you will start to see what are the pump prices for the day. And anybody who drives, especially right now, right, they would pay attention. Okay, roughly, at least they would roughly have a look, right, at the first two numbers, like from Singapore, right, whether it's going to be like 170, 180, or 190, for example. All right, they may not see like 172, 175. They may have missed out the last number, but they will know whether it's 17, 18, or 19. You get what I mean, right? Okay. So every day, as you drive your car, there will be times where your pump is going to be empty, and you need to add up the petrol, right? But can you imagine that the average is between 1.7, 1.8, and 1.9? Those are the fluctuations that you have over the last 3 months, for example. Okay, for the last 3 months. Okay, and your tank right now is at 1/4 tank. Okay, it's at 1/4 tank right now. Okay, and then if you start to drive by and then you start to see that, oh, today's pump prices are at 1.7. Okay, you have a choice, right? You have a choice right now. It's at 1.7. So the question now is, are you going to turn in, all right, and get your tank filled? Okay, or are you just gonna say, maybe I'll just wait for another day or two because I can, right? You get what I mean? Yeah. Okay. Now, so if it is you, most people would react this way, just to be, that savings over there, right? It's at the lower end. I think it doesn't harm to just go and fill it right now. Agree? Now, so this will be what people will be doing at this 50. This. Oh, my mouse is missing. There it is. Now, this will be what people are thinking about doing. All right, when the prices sit on the 50-day moving average line. Yeah, they will start to think, oh, maybe now is the time for me to come in and bargain hunt a little bit, maybe buy a little bit. Yeah, okay. All right, now, then what happens is this. Imagine if you actually pump the petrol at 1.7. And then tomorrow you drive by the same petrol kiosk and then you saw that the price went down to 1.5. Okay, all right, now, what will you do then? Obviously, you have no choice, right? You have no choice, right? Because it's a car, so it works differently. Agree? Yeah. But can you imagine this? Can you imagine it? If you had a choice, if you had the choice to dump the petrol that is in your tank right now, right? Would you? Right? Would you in exchange for the 1.5 price now?
Yeah.
That means in order to capture the new 1.5 pricing, right, you would have to clear your tank first. Agree?
Yep.
Can you see equivalent to clearing your tank means you have to sell, right? Yeah. So what actually happens is when that prices is being cut, it will lead to people wanting to get out, wanting to sell. So even if I had a full tank in my car, right? If I had a choice, maybe I will clear the tank so that I wish that I can clear the tank so that I can pump this new petrol at 1.5. You get the logic over there?
Yeah.
Yeah. All right. Now, so that's the simulation of people wanting to sell. All right, because the urge is there. The urge. All right. Why? Because there's a cheaper price there. Yeah. Okay. All right. Now, so people who have the goods. Yeah, okay, they may actually worry that prices may drop further and further. All right, okay, now, and they want to clear it out. Yeah, okay, now, so I mean that's my take lah. And then imagine it back to the original scenario, right? And then you're driving by over here, and then you see that the prices are at 190, which is at the highest end, right? Now, I think I'm going to drive until that fuel light comes on. You know what I mean? Yeah, all right, I'm going to stretch it until I can't wait anymore. Then I will turn it. Yeah, okay, now, so this is just it. So, when things are above here, when things are still here, where the 50-day moving average line is not in trend, right? People are just waiting. People are just waiting, waiting, all right, waiting and see, when is the very last moment before they need to get in, they need to turn in. Yeah, okay, all right, now. So that's just, if you ask me, that's how I would use the first way to explain it if, somebody was going to ask me about this. I mean, that's my take. Yeah, all right. Okay, now, so let's have a look. So which one is easier? Pump prices or chili party?
That's our viewers just comment then. There's no hurt gonna be there for both of us, which I think ultimately we just want the...
Yeah, me and Jeremy, we agree that, we just try different ways to explain it. And whichever way that fits your bill, it's a good thing.
Yeah. Right.
Right. In the comments, let us know which one you prefer or which one is easier for you to understand. The moving average comparison, chili party or petrol.
So meantime, Terence, just maybe to wrap up the market outlook, as I understand it, you're trying to say is that it's actually because Apple, which is the component stock in the S&P 500, that is one of the most driving factor towards the entire index, actually cross over the 50-day moving average, along with the fact that the momentum in a way seems to be tapering a little bit off.
Yes.
So you are taking a little bit more cautious as well as more monitoring view approach towards the market for the coming week. Am I right to say that?
Yes. Why? Because this is the near term, and the near term shows a crack. So it's about joining the near and the joining back, putting the story back. That means the short and the longer term picture. Okay, now, so the short term picture shows me now that the market S&P is still borderline, but the longer term now shows me that I should lean a bit more careful. That means it may come off a little bit more. So once you see this, right, then you will look for the drivers. What could possibly make what happen? So if I say that S&P will go down some more, then I will think about what can cause it to go down. You understand what I mean, right? And that's where I ask everyone this question. Okay, and Eric and Uncle Fu commented as well that Apple has been the driver. Okay, and the point is this: Apple not only drives S&P. Actually, now Apple drives the Dow Jones. Okay, because before Apple split their stock, right, the stock prices of Apple was trading at, if I'm not wrong, times 4, so about $400. Okay, close to $400, right? And the problem is Dow Jones index is a price weighted index, which means the more expensive the stock price, the more it influences the index. So back then, right, when Apple's prices were $300, $400 a piece, right, they were the single component stock that was literally moving the entire index. Before COVID, it was Boeing. Before COVID, it was entirely Boeing. But when Boeing crashed and burned, right, okay, then Apple stood up. Yeah, okay, all right. Now, so on top of that, driving now the Dow Jones as well as the S&P, can you see the influence that Apple has on the entire market? Yeah, okay, because once it moves, you see this is like a chain reaction. Okay, I'm going to give you a 5-minute lesson very quickly. Okay, you don't understand? Join me for more subsequent sessions. Okay, I may build on it. Okay, now, so the key is this: when Apple moves the index, okay, once they start moving the ball starts rolling. Agree? Now, once the ball starts rolling and the index falls past a certain level, okay, all right, now that will beget what will be the next move? Do you expect, Jeremy? That means once Apple is capable of kicking in a sell momentum in the entire index, that means when sellers start to sell the entire index, right? What do you think will happen?
I think it's gonna be a domino effect all the way down.
Okay, correct. Now, and do you know why? Well, difficult, right? The problem is this: because when Apple as a stock moves the entire index, right, you cannot trade the index. But now the problem is there's index futures, correct? But index futures is where people trade and people use it to hedge as well. Right? But the problem is this: when they sell the futures, for example, right, it ultimately leads, because for the futures to drop, the entire index has to drop. So when the entire index has to drop, right, then people have to go to the market and sell off every component stock in the S&P 500 index. That's where the chain reaction comes. Yeah, and we have not really seen that happen yet. Right? That means you have not seen a totally correlated day where you go and see the S&P 500, right? All 500 stocks are red. You have not seen that yet. Okay, and when that actually comes, that's when the fear has kicked into the market. Right? That's when the market is literally telling you, right, you better watch out. Okay, you better make sure, right, that your pants are on. Let me see where I can find it. There we go. Right now, so you see, even on a down day like Friday we had quite a severe sell-off, right? Okay, but can you see there are still all these green bars over here? All right, now green is very simple. Green means it's up, the stocks are up. Okay, all right, now, so you have an S&P 500 where you still see bouts of green amongst the reds. Yeah, can you imagine seeing a day where all of them are red and all of them are like minus 5%? That's when the market is shooting you a real warning over here. And it's not done that yet. Okay, it's literally not done that yet, because you can see Apple dropped by like 3%. This is Apple. All right, Apple fell by like 3% on Friday. Yeah, okay, but not every stock fell by 3%, correct? And then we even have this stock, APTV over here, that went up by 6%. Yeah, all right. Now, so we're still seeing this kind of balance over here. But when everything is down, that's when you better get worried. And just to build on that, right? So when I pull Apple back to the weekly chart, so can you see now Apple on a daily is bearish, right? So it basically signals to me that I can expect, the more I can expect Apple to do this. Correct? Because if I have to look at the facts on my hand right now, I think that the probability of this move, okay, is much higher than this hitting. Oh man. Okay, then this thing where you bounce off over here. Yeah, right. I think that the potential of it dragging all the way down is higher right now. That means until the RSI goes all the way down to 30, then maybe it's done. Correct, right? Because when the selling momentum comes, right, nobody dares to jump in anymore. Right? And the only time they'll think about jumping in is maybe when the indicators are telling them this is severely oversold. You get the idea, right? Yeah.
Yep.
And then they will start to, maybe I'll buy a little bit. I'll buy like a 20% of my entire size. Yeah, all right. Now, so if that happens, right, now you'll see this. Like I said, even if Apple were to drop from here 110 all the way down to, let's discount the severity. Let's discount it to the 50-week moving average, which is the blue line here, right? But that's still like what, $84? $84. And that's another $20 from here. That's another 20% drop,
Terence, I need to stop you here. Pause. Before you go on, and then next week, everybody is scared about trading, and then nobody attends next week's session already. Okay, so if let's say, for example, on the call to action, like in 3 points, right? In 3 points, what will be your take for our participants, right? If they would prefer to continue trading in this current week, and yet with the looming risks involved with Apple as well as S&P 500 overall, what will you suggest that they do?
Simple. Okay, thank you very much for bringing out this point. One, all right? If you are already overexposed, that means your entire portfolio, if you are already overexposed, that means your total capital, you are deploying or invested more than 50% of your entire capital. You need to do something about it. All right, that means you need to do something about your existing positions. All right, decide to close some, all right, or whatever it is. Okay, you should have 50% of your portfolio in cash if you can. Okay, if you can. All right, but of course, if you're prepared to repair your trades like our community does, then that's a different story. But it still makes a lot of sense to only be 50% invested, right, at least for the next 1 week. All right, because of the uncertainty that I'm saying. All right, okay, two, Don't try to bargain hunt. All right, that means don't try to think that you can scoop short-term bargains with all these high-flying stocks. Because I think some of you are thinking right now, oh my God, Apple has fell from 140 to 106. Let me go and sell some put options. Yeah, all right, okay. And when you sell some put options, even some of you, trust me, I think you're selling naked put options. Don't go near that. Don't go near that because of what I just said. All right, you may think now, oh my goodness, Terence, do you know how much Apple options are giving me now? All right, for example, if I go and look at Apple right now, okay, and I see next Friday's expiry. Terence, do you know how much the 100 put option can pay me? It can pay me 90 cents. All right, that's $90 for just 5 days if I do one contract. All right, Terence, that's crazy. Yeah, okay, all right, now, but if you stand in front of this train and the train goes barraging, then I don't know. I don't know, because I'm saying that if this 50-week moving average holds, then you could be looking at 85. Okay, but if it doesn't hold, then you're looking at 66. Then you're looking at 66. Yeah, all right. Now, you want to pick up Apple. Yes, you can. All right, you can. But then, are you happy with a 90? If you sell the 100 put, are you happy with a price of 100? Okay, because by paying 100 before split price, it would have been 400. Are you happy paying a $400, right, for an Apple stock? Yeah, okay, all right. Okay, now, if you're not, then you better think harder. Why don't you just wait to see if it will cycle down before you go there or go anywhere near that? Because okay, just to answer Eric's question, right? Okay, Eric, just to put it into perspective, does this look, I'm terrible at this.
Terence, you broke the rule,
Yeah, I really broke the rule, all right, because people got me going. Okay, now, Eric, does this look anywhere near like Apple is going to go up to you? Does this look anywhere like Apple is going to go up to you as well? Jeremy, does it look like it's also, going up for you?
Nah.
No, right? No, Okay, good. Now, then let me change it to the daily. Does this look like it's going up to you? Okay, let me circle it. Doesn't want to come out. Okay, here. Does it look like it's going up to you? And then here as well, does it look like it's going up to you? Yeah, that's the problem. That's the problem, Eric. Even if you want to get into Apple, all right, there needs to be some sense over here. Yeah, all right, okay, there needs to be some sense over here. So I don't know. I don't have a price. That's the problem. I don't have a price right now until the indicators want to tell me that I have the odds on my side. Then I'll probably want to jump in. One, because the 50-day moving average has been broken. That's definitely a minus. Right? Two, all the indicators are telling me that the sellers have control. So why do I want to go and fight them? Yeah, all right. I don't have the capital to fight, what's after trillion, Jeremy?
I'm not
I don't
sure.
know, man.
Yeah.
I don't have. Yeah, really, I can't fight them. There's no way that my one single contract can fight them. So why would I want to do that? All right, why would I want to do that? I won't. All right, and we just now we are talking about. Okay, I'm going to finish off after this. I promise, Jeremy. All right, so just now we talked about Apple leading the S&P 500. Correct?
Yep.
What if Apple got the S&P 500 moving, and then after that, S&P 500 started to lead Apple? You get what I mean, right? That means a spark. Okay, a spark caused the fire. But once the fire gets going, all right, it doesn't stop burning. So once Apple can spark the S&P 500 into a selling mode, right, the selling doesn't stop until it's done. You get what I mean, right? So that's where the index turns around and controls Apple. Because if the index turns around and breaks this line on the longer term weekly chart, right, that's 3,000. Do you realize that it can go all the way down to 2008? All right, and that means that there will be even more selling off. All right, then it tells me that Apple may have the potential to go down more, because for the index to go down, Apple has to go down. So again, there are so many things that cause concerns on my end. All right, so the very least I would need to even think about picking something, all right, okay, is to get at least 2 or 3 of these indicators telling me that, okay, the selling has been overdone. Okay, it's been overdone. For example, right, if we look at some undervalued stocks over here, right, WBA, right, the selling has been going on. Okay, it's been going on. Okay, but at least now it tells me that right here, right, the selling may be done. Yeah, okay, the selling may be done. Yeah, okay, at least from that perspective. Okay, now look, the selling may be done, Jeremy. Yeah, all right, but this is not happening to Apple. All right, and Apple is here. Apple is like here. If I have to put the same perspective on the chart, it is not here. Yeah, okay, all right. Or, for example, CVS, probably the same. These stocks suffer the sell-off, right? Okay, now, at least I need to see this when the selling is done. When the selling is done. When the selling is done. Yeah, okay. And if I have to compare this, you look, now this was some undervalued stock versus Apple. Does this look like it's done? It's not. Yeah, all right, it's not. Yeah, okay. So by jumping in right now, I may be just ending up getting myself caught. Okay, I may just end up getting myself caught because, oh my goodness, sorry, Jeremy.
Actually, I'm more concerned is that because because our range of participants actually have a lot of them, like we have very much veterans that they will be able to pick out and they know what to do with the information we are feeding them. There will also be the ones that will be very new and maybe they're just joining us for the first time around. Then they'll be hearing us say, hey, so much info, what am I going to do with them, man? I really don't know. So
I just felt like I needed to do that, Jeremy, because there are so many out there that are still banking on the fact, or people telling them that Tesla is still the big thing. I agree, Tesla has story, they have their batteries, they have whatever. But when the market is in a sell-off mode, when the market is in negative mode, you better be ready. And that's why I've been saying for 2 weeks now. I remember I've been warning like for 2 weeks now that we need to be prepared. Yeah, okay, and you should not be bargain hunting Apple since 2 weeks ago. Yeah. All right, okay. You remember me nagging at you on that too, Jeremy?
Yes.
Because you did an Apple trade.
Yeah, I did.
Yeah, right. And when you did it, remember when you did it, I was like, pounding as well that you better be prepared. Yeah, okay.
Yes.
Because there are a lot out there that have made so much money on these momentum stocks. You know what I mean, right? The trending stocks, right? Because they made so much money on them, right? They start to build emotions with them. All right, and they start to see that, oh my goodness, a stock sell off 20%. Maybe it's time I need to get back in. Yeah, all right. Without knowing that, that's like the end of the game. Yeah, all right. I'm not saying Apple is not fundamentally strong, because if we look at Apple over here, right? Apple still is only at a PE of 32. That's expensive, but it's still reasonable. You get what I mean, right? Yeah, it's expensive, but it's reasonable. Yeah, all right. Of course, we have more unreasonable stuff like this, which is Tesla, which is like 1,000. All right, 1,000 PE. Jeremy, if I'm not wrong, 1,000 PE means to make back your money, you need to wait 1,000 years, right?
Yes.
Correct, right? PE of 10 means 10 years, correct? So PE of 1,000 means 1,000 years.
Yep.
We are not filming back to the future, I can't move back or I can't move forward 1,000 years. All right, so I don't know.
Okay. Terence, compose. Breathe. All right.
No,
So
maybe because being soaked up in the market for so long. Like I said, everybody has a different style. Everybody has a different style at the end of the day. There are trend traders, there are risk traders, there are speculators, there are momentum traders, and then there's what we call the contrarian trader. I'm the contrarian trader. I don't mind, just looking for that short, small little move, but I want to make sure that I find a way to pocket 20% out of it, for example. That's me. Yeah, all right. So I may miss out catching on these Tesla move where it went from 300 to 900. But that's just not me. Yeah, all right. Okay, that's not my style. So, if you think that, oh, Terence, don't worry, I can go to the market, I can be a momentum trader, I can be a trend trader, I can be a contrarian trader, everything I can do. Trust me, you better be careful. Right? You better be careful. Because once you start having like 10 positions, 20 positions in that one account, but each of them are based on different school of thoughts, right? That's when you're gonna get messy. Because when it comes to trade management, you will start to forget, how did I enter this trade? Why did I enter this trade? Which school of thought was I playing?
Terence, I need to time out you. Time out. Okay, 1 minute. 1 minute. You brief, don't talk. Okay, so for context-wise, right, for some of you who don't have a chance or opportunity to actually understand or know Terence from personal point of view, right? He's the type of trader that he sometimes, right, he will just ask me, hey, Jeremy, that so-and-so person, right, who we were with in our community, maybe he trained a while ago, right? He suddenly maybe went quiet already. You were in touch with him or not? Is he doing okay or not? He's that kind of trainer. So he doesn't just train you and then he just forgets about you once he's done the course. So he actually cares a lot. Like sometimes to this point that he's going on and on right now. So yeah, so he's not actually in this panic mode, but rather he's just more concerned that, hey, we have people that is picking up the skill set from us and from this sharing here. And then we really see these dangers from the market, what the market is actually telling us that there's this danger here. We've been warning for a while now. And we just don't want any of our participants to actually be burned big time. Yeah, because we do get them sometimes where our participants, they go through our boring style and then they go out and they try more exciting style and then they come back badly beaten down because the exciting styles tends to have certain element of risk. So this is disappointing to us because it makes us wonder whether there was something else we could have done better by making sure that they could have been safe. How could we have protected them from themselves? But yeah, this is what is going on in our mind in a way. All right, Terence, you ready?
Yes, wait.
One
last point.
Yeah,
yes, one last point.
Let's go.
I know from a fundamental perspective, right, that PE is not the best measurement. It's not the best measurement when it comes to valuing big growth stocks. That means stocks that are in their momentum, right? But you cannot go further than Amazon. Amazon was trading at 1,000 PE back when? Back here, right? Back like somewhere here. Yeah, okay, all right. Now, and that's the problem, right? Because they were at 1,000 PE, they had to come back down, the prices had to crash while they try to start making more money as a business and as a company. All right, and making more money as a company itself takes time too. Yeah, okay, and while they take the time and establish themselves as a great company, right? You must understand every great company started from a small company. Yeah, all right, okay, but it takes a long time for them to get up there. For example, even Apple took a while. Okay, all right, and then if you can remember Apple in its heydays, maybe in the iPod days, there's no more iPods, right? But iPod days,
yes.
Right? The stock flew. And then after that, it came back down before it started flying again when iPhones came out. So what I'm saying is, yes, it can fly, but paying 1,000% PE doesn't make any sense. It makes more sense if you wait for the 1,000 PE to come back down to maybe a few hundred PEs, all right? Then maybe you'll be able to sleep better at night. Because paying 1,000 PE, right, it's just going to mean this, all right? If you just look back at Tesla, okay, I promise after this, I will stop and I'll pass it back to you.
No, that's not the concern. But yeah, go with your point.
No, I just want to make sure that people are aware of this misconception. That's all. All right, because if we look just back in March, all right, and I can remember this very clearly because there was a trade where I issued to my services over here, All right, and we actually got stuck. We were stuck in a call spread, all right, on Tesla. All right, and we were stuck with like a $300 over call strikes. All right, and that was when Tesla went from like $300 to $900, Jeremy, in 1 month. Yeah, all right, okay. Now, then the COVID market corrected, right? Now, and when the COVID market came, all right, the correction came, right? Tesla went from 900 to 300 in 1 month or in a few days, right? To me, right, I gave up all hope on that trade that I was doing. That means I was willing to take a maximum loss on the trade, all right? But within 1 week, I end up profitable on that trade. All right, and I had a 300 call strike with the stock at 900. Would you ever dream that you will end up making money? No, but that's what can happen. So that is the risk that you need to be ready for. That's what I'm saying. So if you want to get into 1,000% PE stocks, make sure you're protected on the downside. You have to, right? For the sake of your money, you have to. Yeah, okay. Because if you're not, then don't push it to anyone if that same much incident happens again. Because technically nothing has changed. Okay, except for the stock prices, except for the fund, story-wise, right? But the numbers, profit-wise, nothing has changed. Economy-wise, nothing has changed. All right, many stores are still not, making that money. All right, because if you look at it, just retail, right? Just retail. Now the story is this: if you sell everything online, your stock deserves to fly. Correct, right? That has been the story, right? As long as you have an online presence, your stock will run. Okay, but they kind of forget this. There's always going to be something new. There's always going to be something new. So we started with brick and mortar. So we have brick and mortar stores where their stock prices went sky high. And then of course we have Neiman Marcus now that is bankrupt, and then we have so many that is bankrupt because of the online, right? So when online came, then we have Amazon. Okay, but who's going to stop the next era then? All right, who's going to say that Amazon is just going to be that big boy forever? Yeah, okay, this just the concern over here, because every stock that went too high, all right, just comes crashing. Not immediately, but they come crashing a certain point of time, because when people stop feeling the hype and they start feeling normal, that's when prices become normal. Right? And it's not the first time. It happened to Intel, it happened to Cisco, it happened to Microsoft. Right? They were $100 over and they fell back to $20 before they resumed the next up move. Right? Were these companies not making money? No, they were flying. Right? Intel was the poster boy. Microsoft was the poster boy. But it's just how people come to terms, right, with a high flying story to the next better story. Yeah, okay, so if you overpay for the story that has been milked, that has been pushed, right, and you happen to catch the last story on that company, then you just need to be prepared. That's what I'm trying to put out over here. All right, so don't go trigger happy. Now is not the time to go trigger happy and loading up your entire portfolio. Now is the time to pick and choose. Okay, now is really the time to pick and choose. Right? Even if I go in, under what circumstances when the market sell off, I will be able to have the minimum damage. Yeah? Okay, I'm done. Jeremy, take over, please.
Okay. Actually, for my take, right, if it's going to be 3 items, right, I be very concise. So if you haven't noticed, I am a man of few words when it's come to non-content sharing, more on decision. Number 1, always have risk-defined trade. Do spreads. Always do spreads. Number 2, take profit often. If you can take profit, just take. The 100% of the trades that you take with profit are 100% of the trades that you win. So sometimes even I make the mistakes whereby you leave the trade too long in the market, and then something that's profitable that just turns out to be a loss. I just had that 2 weeks ago. Yeah, but that's just fine. I learned that. Number 3, be very picky. Very, very picky. So for example, maybe you would have your choice of say 3 factors or 4 factors that you decide or you look at. when you enter a trade. Maybe you like to prefer to add one more factor before you decide on the trade. Maybe you like to add one more condition that has to be fulfilled before you enter the trade. Or maybe you like to add the part whereby you are queuing even more patiently and less aggressively towards getting the trade filled. The point is, while we continue trading, for me, it is continue trading to prevent you to really tilt yourself from the fear of missing out. You don't want to be caught in a position whereby you have one trade that just bursts your account. One, that's why you do a risk-defined trade. Number two, you don't want to be in a position whereby you have one trade that you have a strong win, but you didn't pick it up because you were greedy. Yeah, that happens. You don't want to have a position whereby because you just rely on muscle memory, your usual factors, you just think that it's always going to be the same, always going to be the same. So you intently add one more factor and force yourself to relook onto the entire trade again and ensure that everything is definitely aligned in the manner you like to, and then you take the trade. That way, you don't let your muscle memory be your downfall. So this is the three things that I just want, and I hope everybody takes away. All right. Terence, have any comments on that?
No, actually.
Okay.
I'm good.
All right, then. So, all right.
Jeremy, I understand that you do have something to share as well, and I apologize that I kind of got a bit overzealous as well, and I'm actually perspiring.
Yeah.
But Jeremy, I'm sorry about this, but can you carry the session on your own?
Sure.
All right, I apologize, everyone. I just gotta go because just got notified. I gotta take my daughter to see a doctor. All right, she's a little bit unwell, so I got paged.
Go ahead.
Can you just complete the sharing? All right, and then I will be watching it. I'll be leaving comments as well.
Yes.
Okay, all right. Sorry to just jump out like that, everyone. I apologize for that, but I just need to take care of my family as well. So I will be watching the discussion. I'll be jumping in as well on comments. So Jeremy, please take over.
Sure. All right then. So let me just get the slides up. Yeah, this is the slides here. Right here. So the sharing today is a continuation of what we did last week on the follow-up for post-earning updates of your outlook after Momo. After Momo actually announced their earnings on, I think, the 3rd of September. All right, so for some of you who may be just joining us for the first time, or maybe you have forgotten what the company is about, it's actually a social media company. Basically, it just does something like mobile applications, streaming videos, and they match people, or they match to try and help expand people's social relationship network based on interest as well as on location here. All right, we have run through the numbers on the last session. Generally, the outlook of the numbers don't have much of an issue. And one of the more notable points is that we noticed that the price book ratio, or rather the book value of the company, actually went up by about, say, 50 cents since the first time we did the sharing, I believe on 23rd of August here. All right, so in terms of the numbers here, we actually did look at a trade whereby we could consider here. And as I look at the trade earlier, while we were doing the sharing, the mid price of the trade has actually moved down from 34 cents to actually 24 cents because the company actually moved up in prices here. So it was at about $14.20 there, and actually moved up by about 50 to 60 cents over the week as well from last week's sharing. All right. So today's segment is actually more about what kind of reading they actually do to help supplement the decisions right into updating the outlook that I have here. Okay, so let me just fire up the things that I actually go into. Just give me a moment, yeah. Meantime, if you have any questions, right, just continue to actually load up the questions into the comments here. I will be taking them up gradually. Okay, so just going to do an update here, right? So what I would do after I have looked through the Morningstar data for the company's financials and come to a rough feeling about the company's numbers, is that I will try and have a look at terms of the Seeking Alpha page. Right, Seeking Alpha is actually something like another social media page for stocks and for investments. So there will be a lot of people trying to gain some following, gain some reputation on Seeking Alpha by sharing their posts, sharing their outlook and their comments and the reports here. So what you do is that you must, for me personally, I learned that you must be able to establish a timeline of the report so that you can get a proper informed look in terms of how is the company outlook going to be like. Okay, so let's see. So on 3rd of September, Momo announced their earnings, and you see that on 3rd of September here, this is all the earnings headlines here. And we have the transcript. Let me just see whether it's being shared on the stream. There it does. Okay, so this is something like the call transcript. You can have a look if, let's say, for example, listening to the video helps you. You can also listen to that. Yeah. And you can actually listen to what is their scripted sharing for the earnings conference, or rather, earnings conference. Yeah. So I usually don't do the earnings conference call because to me it's more of something like a PR kind of sharing. Coming from a corporate background, right? What goes into a scripted response, right, is a lot more nicer than what actually goes unfiltered into this script. So I don't look at those. I generally focus on the summary here. Right, so headline very simple. -6.5% on multiple downgrades following Q2's weak guidance. Keyword is weak guidance. That means to say they are anticipated to have something like a poorer returns, poorer performance moving forward in a way. So you must remember, stock prices are not actually the full function. The price of the stock is not the full function of its business. It is the function of people's belief, sentiment towards the stock. So as long as the company is doing well, but the people's belief that the company is not really doing as well as they should be, the stock prices will not be as good. The other way around is also true. If the company is not doing very well actually, and it's not actually profitable, but people believe that the company has a future. People believe that the company has a certain niche that they like to actually park their funds with and see whether they can earn the future returns. Then the stock prices will have a certain level of depth here in terms of how they can be. So weak guidance here actually kind of like manages the expectation, the sentiments for market participants here, right here. So we see analyst issues downgrades. Okay, so we notice that downgrades. Okay, so when we see downgrades, right, sometimes you see price targets. Cut price targets to $16 from 26. Okay, current price of 15.71, and then we also have cutting targets to $17. All right, so and they will also have all these things whereby it's neutral, it's outperforming, it's overweight, underweight, whole. All of those headlines, I disregard. All of them I ignore. Because to me, they don't make any sense. To me, they are just one word keyword whereby they try and, in one word, feed the viewers what they think is, okay, let me paraphrase it. They try to use in one word, right, to capture the viewer's attention to what is this report about. But you see, the thing is, if the report can be so simplistically said in one word, then why are we having session whereby we are going through the entire process of thinking in two weeks of 1 hour plus sessions? It doesn't work that way for me personally. I don't believe so. So see, neutral, I ignore this part. I look out for this part. Highlighting a recovery that may take longer than expected. Okay, recovery that may take longer than expected. So this is a hit on the sentiments, the moving forward sentiments. All right, so and then we see. So this is part for the summary here. Now, so you have to understand that on the 4th of September, this is summary. So on the analysis part, sorry, you have to look out for anything that's after 4th of September. We have 1 and 2. Okay, personally, I don't pay for the premium Seeking Alpha account because I don't really see the value here. And if, let's say, for example, if I'm really tracking a company for persistent long time that I really believe that I'll be parking funds into them which I seldom do because I don't really go long on stock directly. I mostly do options play. So I don't need them. But if let's say, for example, you're one of those who are thinking to actually long on stock directly, then you may consider actually getting one of the premium accounts here. So we can see that under promo, the second one, because there's no lock here. See that there's no lock here. The article is still available. So this person, this analyst by the name of Jason Dietz, he shared. Okay, so before we do the sharing, let's go into his profile and then we see what he does here. He has been a contributor since 2014, and he has a company called Radoff On Institute. So let's find out what's this about. So let's see. Seems to be a company based in US. Can't really tell from a very quick glance. So I don't really go too far. If let's say, for example, I can quickly pick up the details here, then I'll do that. But if I can't, then I wouldn't really let it bother me as much as I can. So let's see what he summarizes this out. He says 10 years experience in foreign policy research, appeared in Forbes, Toronto Star, and things like that. Okay, that sounds certain level of qualifications here, right here, and 74 articles, 3 blog posts, 104 comments, yada yada, 316 followers. Okay, let's see what he has to say. All right, so summary-wise, he says experience extreme growth recent years, going from minor company to $1 million powerhouse, strict execution, becoming a recognized player in China. Unlike other Chinese company, virtually no overseas exposure, revenues are all domestic. Okay, on and off, and we see. So generally what I do is I'll do very quick reading to see whether there's anything else. Okay, so we see that, okay, number one, subjected to shutdown in services or forced to close that, sell them to American companies. And then we see. Quickly just run through. Revenue increased by 24, 5 years, things like that. So what I've done is I would have kind of shared with you a very high touch rate of the kind of process that runs through when I do an outlook. Okay, so I can actually give you a very quick summary in terms of what he shared in the entire article here. So essentially what he's trying to say is that the company has experienced very much great growth. Company is focused in China as a in terms of its revenue. There were periods of time in the company's history that in the last year that it was forced to actually do something, what they call it, it was forced to actually have to shut down parts of its operation due to certain regulatory requirements also. And there were that, because despite those things, right, they actually kind of perform reasonably well. So after those regulatory requirements has been cleared, they should be able to do much better in the coming year as long as the conditions does present itself, such as likewise similarly. Of course, China's recovery in a certain sense also will help the company's outlook here. So now you have to understand that, okay, on this matter here, I just removed that slide here. On this matter here, you have to understand that, hey, are you what they call it? When you got the numbers in terms of the book value being an improvement of 50 cents, and then you see that sentiments wise, right, you kind of have someone summarize for you, hey, what happened to the company in the last one quarter, last 1 year. So we have for Momo, what happened is some of these business or business services was actually forced to shut down or have to suspend their services because there were some illegal activities going on in their platforms. One. We also know that because they acquired Tantan, which is more for offline kind of a social networking, and with COVID-19 forcing all offline activity to kind of a standstill, the new acquisition kind of didn't pay off immediately. So that's true. Despite that, the company still posts a pretty decent return overall. So you have all these factors that usually put together, hey, and then you see that, okay, number one, we have the book value that went up. We have all these things that's actually going up. We have the country, the revenue is actually based domestically in China. Okay, so now you as a point, you have to decide, do you believe in the stories that you see? Do you believe in the numbers that you see? Okay, so this is where it gets a little bit tricky. And for some of our participants, right, you will be put off here. You have to understand this, you see. When it comes to the same picture, if I were to put it to two person at any point in time in the street, they will not always give me the same observation. You have to understand this. They will not always give me the same observation, and they will not always give me the same story. So you have to decide for yourself whether it is something that you accept based on your understanding, based on your expertise, based on your level of experience here. For me personally, I have no doubt that the Momo business, number one, in terms of book value, it went up. I am very big on book value. Even if, let's say, for example, that the company does close down now, if I were to take a trade here, it has higher level of cushion in terms of the value to cushion the risk of bankruptcy. Number two, the choices of the options available are still there. Number three, China as a domestic revenue only, that is a very big play for me because amongst all the countries in the world that has recovered from COVID-19, I think it is without a doubt that it's only going to be China. And when it is the first country to recover strongly from the COVID-19 situation, we should be seeing that it should naturally translate into the economy here. Now, of course, there will be people who will be skeptical whether the data that they're sharing will be true and things like that. Yes, I do agree with that. Yeah. So those are the things you have to put together here. For me, I'm a go. I will continue to look out for Momo, and I will be looking out more closely with that. So with this, I have actually been more in touch with Terence in terms of like seeking his assistance in terms of technical analysis, when is a good time for me to enter there, and I'm looking out for more parameters to actually look out for Momo here. So this is one way you can update the outlook here. So if you have been trading Momo, for example, you took up the trade previously that we shared, if I can just up the slides back then, give me a second, yeah. Meanwhile, if you have any questions, right, you can just post them in the comments. I'll pick them up once I'm done with my entire sharing here. It shouldn't take very long. So this was the trade that we kind of look at when we did the sharing on the 23rd of August here. So back then we were looking at a spread of 1660 or 1660 to $15 with a deposit of $116, and we'll be collecting about $35. Now, if any of our viewers here who actually took out a trade, right, you can actually leave a comments here so that we can be aware as well. Yeah, so if you would ask me how would I be taking on the trade here, there will be two things I'll be looking here. Number one, for sure, the trade is definitely in the money here. Because if I were to look at the price for Momo now, it's about 14.82. So it's under by about close to $1.30 there about here. So no matter, we still have some time to wait before the 15th of January, which is the next January, about 3 months there. Yeah, so coming to November and early December, you have to make a decision to decide whether you need to close if, let's say, for example, the stock has not recovered by then. Yeah, so you need to look out for that part here. Otherwise, right, if let's say, for example, you have taken up the trade, which is from our last sharing, which is on the 5 and 30. Let me change the screen over. $5 and $3, right? So this part here, the trade remains relevant, and what I've shared last week remains the same, whereby you have to be able to queue very patiently for the same trade, because the width of the entire trade is very wide in terms of the $P spread. It's currently at 12 cents to 24 cents, which is the entire natural to meet price here. So you will see that because of the premiums per one cent difference, right, it's actually a world of difference in terms of returns percentage as well as annualized returns here. So it's best that you actually queue for it patiently. Yeah, but the thing is that you have to understand, if you were to take the trade, you are actually taking a trade whereby you are more of waiting for the decay in a way, like for the stock, such that as long as the stock doesn't fall below the $5, you will be able to collect this premium safely. If it does fall, even if it does fall to say maybe $5 region, you are kind of like cushioned with the 950 book value that we have. So that's kind of like the basis whereby what we mean, we stack more odds in your favor. Like for example, when we say stacking odds, we have book value to help support your price. We have technical analysis. We have sort of moving averages. We have your pivot points. We have all of those things that we use to actually stack your favor, odds in your favor here. Yeah. So I think with that here, so the how I've actually finished sharing in terms of how we kind of did an update for an outlook for a stock. It can be very fast. It can be very slow, depending on the resources available as well as depending on outlook. Sometimes if you see that the outlook is entirely one directional from the previous time you did the analysis, then yes, it'd be very simple. But for most case, right, there will be a bit of a divergence in terms of like the outlook overall. So this was a good example that I felt that we could still bring forward, whereby the outlook kind of have a divergence, but the overall track is still intact for me personally. Now, do we have any questions from our viewers here? If you have, just leave any questions here, and then just wait a moment to pick it up here. Meantime, let's see if you have any questions that maybe we could try and address. Yeah. Yeah. So maybe as we wait for a while to see whether there's any questions coming, right? Just sharing some personal view to extend a little bit on what we were mentioning earlier in terms of the market outlook here. Now, Eric, if you're still around, right? So what you were looking out for in terms of the entry price for Apple, right? If I can say, right, you can also use certain of the ratios as a way for you to actually start paying closer attention to the stock to decide whether you decide to enter. Because, for example, if you notice that, say, for example, when Apple prices, maybe any particular stock prices, they start to move up or down, right? The market will also be moving up and down. And also at that point, different companies announce their earnings, different announce their results, and that particular company that you're tracking also announce their results, right? The returns ratio, their returns on equity and asset also will change as well. So if you could identify a point whereby, right, the company's, say, price book or return on asset, returns equity is starting to trend more closely towards the average of its, either its 5-year average or starting to trend more closely to the index average, okay? Index or the sector average, right? Then that's where you can start to pay a little more attention, because that is where it's cutting to a value close to the index or sector. Okay, so if you get this, yes, that's good, because this has been what we've been drilling indirectly over the last 12 sessions. This is the 12th session that we'll be sharing already. If you don't, yes, then you need to come back more for our show here, for our sharing here. Yeah, I don't see any questions. Yes, so I think I will end off the session today. Yeah. So with that, I thank you for your time, and let's join us again for our next session as we share for the next stock sharing with stock Nit-Picking with IMP, Terence and Jeremy. Thank you, everybody. Goodbye. Enjoy your weekend.